Joining in two important market voices, Manish Sonthalia, Director and Chief Investment Officer, Emkay Investment Managers, Ajay Srivastava, MD of Dimensions Corporate Finance Services. Gentlemen, both of you, thank you for joining in. Thanks for your patience. It's just that kind of a day wherein the conversations tend to spill over a little bit. But I'm just trying to understand, Manish, as we head into this budget, are you constructive or do you fear that no big bang announcements might lead to a market sell-off?
No, exactly. As like any other budget, a lot of expectations built into the run-up to the budget. But, if you look at it practically, what are the things that they can do, given the situation that we are in? So, not too much of expectations going into the budget. Markets will watch out very carefully as regards any alleviation of the problems of STCG, LTCG and STT. If that comes through, many of the things regarding the problems in the stock market could be taken care of. But otherwise, if it's run of the mill, like you have a 4.2% fiscal deficit, nominal GDP growth of 10.5%, a gross borrowing number is the key number to be watched out for. 16.5 lakh crores and beyond is going to be taken very negatively, and anything less than that could be taken positively. Capital expenditure, 12.5 lakh crores, defense, 7.5 lakh crores. These are all known numbers. Nothing is going to surprise very positively. I think the only thing which could surprise very positively is some consideration on capital gains tax from a foreign outflow perspective, because these are the guys who are selling. And if this doesn't come about, the trajectory on the downside could continue. Of course, there's high degree of margin of safety as far as the valuations of the market currently are concerned. I'm not too negative, but you could see a sell-off if these things don't come.
Weigh in on that. Is your mood buoyant? Are you positive or are you cautiously optimistic? What's the view?
At around 25,000.
No, I'm talking about Ajay. Ajay, you want to weigh in on that? Is your mood buoyant? Are you optimistic? Cautiously optimistic? What's the view?
Well, our mood is optimistic because I think the government has done a lot in the last 1 year. Unfortunately, it has not worked on one principle. Biggest one will be the FDI, FPI, because that's a critical piece for Indian economy. That's not worked. And I think that's where we are looking at the budget and saying, is there going to be structural changes? Is there going to be difference in approach to this fact? That's one. So FDI and FPI reversal steps, that's the one big priority we are seeing. And we're optimistic that something will be done for that. And of course, the next one is we are optimistic about the change in PSU banks. I think the approach to PSU banks may change. I don't think they'll privatize, but I think the approach will change, and that's going to be very constructive for both the index and the market, as well as for the Indian lenders and the people, because I think having competition in the banking industry with good quality PSU banks now modernizing, that would do wonders. So I think two places, FDI, FPI, and PSU banks, I think there are two big pillars. I think we are very optimistic that you could see good steps coming through, and we should positive outlook for that one.
Okay, you're seeing pictures of the finance minister outside the steps of Parliament, where she will now proceed, and then the budget session, which has begun, will see the whole process of Finance Minister Nirmala Sitharaman presenting the budget. You can see the Chief Economic Advisor there on the top step as well, and the entire team that has gone through this process of presenting the budget this year. Surely not an easy one. I mean, no budget is easy in a nation as complicated as ours. There's always balance to keep, but this one is particularly difficult. I'm wondering, Manish, I'm going to come to you first on this. If there is no long-term capital gains relief, and it may not be there, if there is no tinkering at all with tax, but more of a broad messaging on where the country is going, would that be seen as a negative by the market, or would there be a sigh of relief that at least nothing has been done to disturb the status quo?
No, I think if, it's not going to be anything big bang, then I think the trajectory of the markets would be what it is today, negative. So you could see a continuation of a sell-off from tomorrow. Of course, valuation comfort is absolutely there. The negative runoff could be there for a day or two, and then people will weigh in the positives and negatives accordingly. But I think the trajectory, a big bang reform could be on the capital gain side. If that is to come about, then FIs will sigh of relief, you could have the FII flows get reversed.
Rahul Arora, CEO of Ashika Institutional Equities, also joining us this morning. Rahul, very good morning to you and thanks so much for taking the time. I'm going to start with a non-budget question though. I'm going to start with a pack of stocks that is toppling like a house of cards, and that is the metal pack. What would you say about what we're seeing right now? Is it really par for the course based on the underlying, the way that it's moved? Or do you think that there's more at play here? It could settle, it could go up again.
Morning, Alex. Thank you for having me on the show. I think the short, humorous answer to your question would be either get an oxygen cylinder or sit on the Ferrari Rosso in Abu Dhabi. I think if you can manage either of those, you're going to manage this. But I think, what's happened in the metal sector obviously is a bit of an extreme. You could argue that the run-up itself was a bit extreme. But typically, as you've seen in stock prices as well, these things tend to stabilize after the kind of move that has happened. Of course, the news flow around the new Fed, etc., have, not aided in terms of sentiment, but I think the kind of run-up that had happened, I think it's just par for the course. Would I be a buyer in these stocks? No point catching a falling knife going into the budget. Let's see what the reactions post the budget are, but I think we could be close to the end of what you have seen, both on the underlying as well as from a stock perspective.
Okay, and I'll take a question to Ajay, of course, but Rahul Arora, congratulations on your new role as well. But Ajay Srivastava, come in on that. I mean, just the volatility that we're seeing across asset classes, but particularly metals, right? And that has a big impact on, well, household savings if you've not sold your family silver, but on the stocks as well. How do you look at this? Because it's devoid of what the budget can do for them any which ways, the metals pack.
I think what's happening out there right now is, of course, as I'm not too sure, the MCX has just changed the margins on all the silver and gold. They've increased the margins. So it's a very peculiar situation. They've increased the margin on a Sunday, but I think both silver and gold are in a circuit. So at the end of the day, I'm not even sure what an investor can do. So I think let's be honest about it. These investors have been taken for a ride by global institutions, which engineered the collapses thing. And today, institutionally, what do you do on a Sunday when you change the margin norms for investors and the market is at circuit? Then what do you do? So I think there's no fundamental left to analyze anymore. I think it's a question of the regulatory overhang on this, both the products at this point of time. And as an investor, you just have to sit and watch and see what's happening, because the call is not on fundamental RSI, demand, supply, anything. The call is, can you put in the margin, 60% margin today on a Sunday and keep your holdings, or do you cut? You cut, but you can't cut because it's in a lower circuit. So I think, this is a peculiar situation where institutionally the actions of regulators, both overseas and India, have led to the point of a collapse of a product and a diversification of asset, which was working sensibly for investors. Now, can you ride through it? The answer is you should be. If you can ride through it, I think you will gain. But the question is, how do you survive on a Sunday with margins and open positions and circuits? So long term makes enormous sense. Rupee is depreciating. We don't produce silver too much. We don't produce gold at all. And therefore, long term hedges are relevant and should be there. At what pricing? Your guess. But the question is, can you ride today and live for another day tomorrow?
Ajay, apart from the pain for anyone who has taken positions in silver and gold on MCX, just focusing on equities and what's happening as an impact of that with Hindustan Zinc, Hindustan Copper, and all of these counters sliding down. Once the dust settles, are these now attractive, or could they be attractive at some point, or would you stay away from the entire metals pack for now?
Oh, no, not at all. I think metal is a good place to be. I think historically, if you will see last budget to this year, they have been the best performing.
Yeah.
We believe they will be in the top 3 performing again, because simple fact, they are monopolies at the end of the day. You can't produce an overnight, you're going to mine. Number 2 is globally, the prices are benchmarked in dollars, and if rupee continues to depreciate, you will see the natural increase in the prices of the commodities. And the third part is, all these companies in India, by and large, are pretty well, apart from maybe Hindalco, but perhaps they hardly have the kind of debt which can create an overhang on them with good dividend paying record. So I think fundamental story of metal remains strong. If India has to grow, you need metal at the end of the day. And these are non-ferrous. Non-ferrous is the most precious commodity in the world today. At the end of the day, I'm not talking of steel as a metal at all, but I'm thinking non-ferrous, aluminum, zinc, copper, all these are required for the new age industries. So you can't live without them. So yes, temporarily live out of this one. But our belief is, again, for the next year, when you sit there next budget, you will find these will be in the top 3 performing indices on the Indian market.
The view on metals and defense this morning, Manish.
Yeah, so Tamanna, see, one thing is for sure that a portion of your wealth should, or your total asset allocation should have a component of gold and silver. But having said that, the other base metals, the industrial metals like your copper or aluminium, we need to understand one thing. If the prices of these metals go way beyond what it is historically, or whatever there has been the movement historically, demand gets destroyed. So if you're using copper for AI and data centers and electric vehicles and renewables, all of that is understood. But if the prices go way beyond levels, what is being projected, let's say 2040, there's going to be a massive shortage of copper. So copper should be going up. In the interim, you will have postponement and destruction of demand. Similar, and aluminium is a substitute for copper. So if copper goes up, then aluminium goes up. Of course, there is again going to be a postponement of demand. So I think immediate prices of metals really don't translate into earnings per share of the underlying securities. I think the best play out here is to question your assumptions on the pricing very carefully and then see where is the value. In today's context, I see value in Vedanta, which is a play on Hindustan Zinc, which is a play on, let's say, aluminium prices, because they have a lot of 60% of India's aluminium gets produced by them, plus the demerger story, etc. So, but on the other hand, let's say Hindustan Copper, if you're assuming that the prices are going to go way beyond what it is today, what is the total mining capacity? 4 million tons going to 12 million tons by 2031, and 1% concentration translating into, let's say, 1 lakh ton of copper by 2031. And you give them the EBITDA multiples, still does it make sense? So these are the questions to answer rather than just taking a proxy play on the metal prices on a day-to-day basis.
Answer though, Vedanta may be something to look at. There's a demerger at play too, so keep that in mind. By the way, next sets of guests about to come in, Ashish Somaya and Anirudh Sarkar, so watch out for that as well. But bring in Rahul Arora in this conversation. And Rahul, we started off with a non-budget question, and at the onset, of course, Rahul, congratulations on this new role as well. But from the budget, Rahul, in specific, do you expect to get a winner the way you probably praying for Novak Djokovic's victory today?
I don't think I'm praying for anything more than Novak's victory today, Niraj, sorry. See, we're all brothers. But no, I think, Niraj, I think she has a very tight rope to walk. I think post GST cuts, the indirect tax collection has been low. So we're looking at a tax collection of about 9-10%. I don't think she can look at capital expenditure more than that number. So it's probably going to be 9-10%. Obviously, the big kicker that people are expecting going into the budget is the defense spending because of what's happening geopolitically. I think defense spending was up by about 57% in the current fiscal year. On that, it's projected to grow by about 20%. I was listening to Manish a little earlier. I mean, if you get anything on FII taxation, obviously you have a case where the Nifty between today and tomorrow could be up 1,000 points. But I think the probability of that is extremely low. But I think she'll probably walk a tightrope. She'll probably talk about 4.2% fiscal deficit, the roadmap for debt to GDP at 50% by FY30. But I think, at the margin, she may do a bit for the tariff or export-related sectors in terms of credit subventions or credit guarantees and interest rate subventions, and maybe PLI extensions. But there's not too much headroom post the income tax, extensions last year and the GST cut. So also, Niraj, we have to keep in mind that India as an equity destination today is not the most attractive in the world. I think, if you're looking at a 12-13% kind of earnings growth for FY27, and that's the kind of return that you're expecting from capital markets. Your rupee depreciating by 4-5% a year from an FI perspective, you're already down to about 7-8%. You add to that your 12.5% long-term capital gains tax. You're getting the US 10-year bond yield at 4.5%. Safest asset in the world today, what Ajay was saying in terms of strengthening dollar. So why do I even look at India if post my taxes and post, rupee depreciation, I'm getting only 6.5-7% for a couple of percentage points. Even from an Indian standpoint, Niraj, I think the way gold and silver have rallied, there has been an allocation shift in terms of people's portfolios. People who were probably 75-80% equity have probably dropped down by about 10-15% to alternate assets. And I don't think this fall is going to shake them because of the kind of run that you've had. So I think she's going to have a tight rope to walk, but I think we need to be a little pragmatic about the kind of returns that we can expect from the stock market. I think this is going to be another year where the Nifty probably goes to sleep between 24,000-27,000 at best.
Oof, it's feeling like deja vu because I think we had the same conversation a year ago. But thank you so much, Rahul, Ajay and Manish for speaking with us on this leg. We're keeping it fast and furious here this morning on NDTV.